VIG is a well-diversified dividend appreciation ETF from Vanguard. It's been around since 2006 and has a solid track record. It's the ETF that just keeps chugging along in any market. It'll never wow you compared to some of its peers, but it'll also never completely let you down. In this video, we'll walk through the key metrics of VIG, and we're going to check out how it compares to similar ETFs. I review a lot of quality ETFs on this channel, and I want to quickly touch on the fact that when I give an opinion about a better solution, it doesn't make the ETF bad. It's like when people debate who's the GOAT between Michael Jordan and LeBron James. I would tell you, oh, Jordan, that's easy, next question. But that doesn't mean LeBron James is bad at basketball. He would be a fine player to have on your squad at any time. He's just not the greatest player of all time. All the ETFs that I discuss on this channel are solid at worst, and they're easily worth a roster spot compared to the following. Not investing at all. Picking your own stocks instead of rolling with passively managed ETFs. Paying fees to a financial advisor to screw it up for you, or sitting on your cash forever and not investing at all. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this, please smash that like button and tell a friend what you did. Also, drop me a comment below with your favorite ETFs. I'd love to hear about them. Let's grow. VIG Basics. VIG is the Vanguard Dividend Appreciation ETF. It is passively managed by replicating the S&P US Dividends Growers Index. And that index first screens all companies that have increased their dividend payout for at least 10 consecutive years. And then after that first screen result, it drops the top 25% of the dividend yielding companies. Wait a minute. VIG screens for all companies that have increased their dividend payments for at least 10 years, but then within that group, it cuts the top 25% of dividend yielders? Wouldn't that hurt the cash flow of the ETF? Yes, it does, but it also systematically helps us avoid yield traps. Companies often have yields that have shot up because of the underperformance on the stock price. This makes the yield of VIG quite low, but I personally appreciate the trade-off of pulling in more sustainable businesses. VIG Key Metrics. Let's dive into the key metrics of VIG before we start comparing it to other ETFs. I've pulled up VIG on Seeking Alpha, the best website for researching stocks and ETFs. And as you can see here, it's the Vanguard Dividend Appreciation ETF. And I'm here on the Summary tab. The first thing I like to look at, as always, is the expense ratio. And a 0.06% expense ratio is razor thin. That'll keep the profits in our pockets. And the second thing I like to look at is the assets under management. And when you see 88 billion, that's a well-established, huge fund. You want at least 5 or 10 billion just to make sure the fund isn't going anywhere and that the methodology can always work itself out with new funding. As I always mention in my other videos, the most important aspect of an ETF, in my opinion, is the management methodology. It must be passive. And in this case, I see that the VIG seeks to track the performance of the S&P US Dividend Growers Index by using full replication technique. So that's good. That means it's passively managed. And we already checked out how that index operates earlier in this video. So we're good to go on there. No human gut decisions. Let's check out the holdings breakdown. So it's a fairly well diversified fund. It is 23.5% in technology, but that's actually relatively low these days. The SP 500 is 29 or so, and QQQ, sort of the growth index, is around 50% usually, but it's still higher than the SCHDs of the world. So this fund is going to inevitably have some more overlap with things like VGT, XLK, and QQQ. And it also has a nice chunk of financials, healthcare, industrials, and consumer defensive, all in the double digits, and then it has some consumer cyclical as well. This is a fairly well-balanced fund. And now on to the top 10 holdings, and I like to just make sure that the names are all recognizable. These are extremely recognizable. This is a very well put together top 10. Apple and Microsoft make up about 10% of the fund, but if you look at the top 10, it's only 32%. That's very well diversified, and you have 317 holdings, all of which have grown their dividends for over 10 years in a row. That's pretty impressive. On to my favorite tab by far and away, the dividend summary. So we do have that low 1.89% dividend yield, but its 5-year dividend growth rate is a juicy 9.5%. That's really good. This is what you compare to inflation or your yearly salary increase. So if you grow at 9.5% a year, you're going to crush inflation. And that's the per year over the last 5 years. And it's grown its dividend each of the last 10 years. That's another great stat to have. I like to just kind of scooch up here a little bit and check out the 3-year CAGR, which is an even more solid 11.8%. There's that 5-year CAGR, and the 10-year CAGR is right in there at about 9%. So very solid and consistent dividend growth here. And speaking of dividend growth, I always like to just take a look. Back in 2014, it was paying out $1.59 per share that you held. And fast forward to 2023, and it was paying out $3.21. That is a nice increase, and you can see it's been pretty consistent here. So now I'm on to the charting tab, and we're gonna take a look at total return versus some of my other favorite dividend ETFs. I threw in DGRO, which is a bit lower yielding and more growth oriented like VIG. And then I also threw in some true dividend ETFs with higher yields just to get a variety here. So in the last 1 year, VIG is up an impressive 12.3%. DGRO comes in second place at almost 10, and SCHD is lagging at 3.4, and VYM is lagging at 5%. Over the last 3 years, you see VIG is in last place, but it's very close. It's basically tied at 26% with DGRO. And then the higher yielders have fared a little better in the last 3 years, almost 29 for SCHD and almost 31 for VYM. Let's zoom it out over 5 years. And over the last 5 years, VIG is up 87%. That's second to all these dividend ETFs. DGRO is lagging a little behind at 81%, still solid. SCHD is winning this category at 88%, and VYM is lagging the field, 64.1%. We're going to zoom it out over 10 years, and I'd like to point out that DGRO doesn't quite have 10 years of history, but it's close enough, so I threw it in here. But VIG is 178%. That's very solid. DGRO right behind at about 168. SCHD is number 1 of these dividend ETFs at 189%. And VYM is lagging the field at 147.8%. So VIG is right in the mix. VIG versus the Dream Team. There are so many great ETFs to choose from, and there's really no perfect way to set up a portfolio. But it is important to make sure that whatever ETFs you do select complement one another. I think that any modern portfolio should consist of 3 types of ETFs. You'll want a cornerstone ETF that gives exposure to the broad US stock market. You'll want a growth ETF that focuses on companies with high growth potential. And you'll want a dividend ETF that focuses on companies that pay and increase dividends. The amount of each of the 3 categories that we should hold in our portfolios will depend on our age, our risk tolerance, our status in our career, and our retirement goals. My favorite selection for each category and what I actually invest my money is as follows. Cornerstone ETF is VU. For the growth ETF, I roll with VGT, but I also highly recommend QQQM for anyone that thinks that 100% technology is too much. And for the dividend ETF, I roll with SCHD by a mile because it's a wonderful counterpart to VGT. I don't think that VIG falls into any of these 3 categories. It is a dividend ETF, but it has a low yield of 1.9% because of its methodology. And I don't think that's a bad thing, but I also don't think that we should directly compare this to something like SCHD or VYM that are over a 3% yield. And VIG has a lot of quality growth stocks as well, which makes the overlap a little bit higher with something like QQQ or VGT. VIG is a worthy investment, don't get me wrong. Let's take a look at some comparison data to find a home for it. This is a spreadsheet that I use to compare ETFs over time. You can see here I last updated this spreadsheet on 1/7/2024. I list all the tickers here, and then I try to define a role, and I highlighted VIG because that's the point of this video, of course. So the roles I have are dividend, and that's things like SCHD and VYM, you gotta at least have a solid dividend yield to be in there for me. Cornerstone is things like VU, ITOT, which is like almost the total market index, and VTI, which is total market index. Those are just your cornerstone, give me a big slice of the US market. And then you have your growth, of course, and we've talked about those quite a bit, just growth oriented funds. And then I've added a new category called hybrid. Basically, it's a growth and dividend hybrid, but I don't quite consider it a cornerstone, but it's things like DGRW and I think VIG fall in this category. It's basically a cornerstone-like fund, but instead of the entire market, it's usually following a more specific index. So that's a quick way to say, let's just look across at VIG at some of these categories. A nice set of holdings, very low top 10%, which means it's pretty well diversified. Passively managed, of course. So on the expense ratio, it ranks 6th among all these. And then we're gonna hop over to dividend yield. And let me scroll the screen over a little for you here. I see it's off my share. Let me get it right there. This time I remember to lock the cell so we can still see what we're looking at here. So this is a good one. Right now I have it sorted by total rank. It just takes an average of the ranks. It doesn't necessarily mean it's the best fund. I just sort them by this just for something to go by. But all these columns are sortable. So if we take a look here, you can see the true dividend stocks are SCHD and VYM. I refroze the panes. Now we have the roll here. So you can see these ones like SCHD and VYM, they're clearly dividend payers, dividend yielders. The things like VIG and DGRW, my two hybrids so far, they're a little higher than the cornerstones, which have a little more growth oriented stocks, but closer to the cornerstones than to the true dividend yielders. So that's that new category I made, that hybrid. And then you can see the growth ones here, as you expect, they do have some dividend paying stocks, but they're clearly a lot lower because that's not their intended role. If we look at the 10-year dividend CAGR while we're out here, these will vary a little. Some of the growth ones actually, QQQ is doing well. The VIG is right up there. And I really believe that VIG will be number one on this soon. That's the 5-year growth rate. And then if we look at 10-year total return, you would hope with the bull market, most of your growths are up there, and they are, as you can see here. And then your hybrids, well, DGRW is outperforming VIG by a bit, but that could change in the near future. So VIG is a little lower on the total return over the last 10 years, but we'll see how that trends moving forward. VGT and SCHD mix, the better hybrid. VIG is a solid ETF that I think will perform well in any kind of market. But I still think that creating your own hybrid fund with 50% SCHD and 50% VGT will outperform VIG long-term for your portfolio. That mix currently beats VIG at all three metrics within the Holy Trinity. It gets way higher total returns, and it also has a higher dividend yield at just over 2%. And believe it or not, the one thing VIG is made for, dividend growth rate, the mix currently beats it at that too. Specifically talking about the 5-year dividend CAGR, the 5-year compound annual growth rate of the dividend payments. I do fully expect the dividend growth rate of VIG to outperform that of SCHD and VGT moving forward. But I still think the mix will have 2 of the 3 categories, and ultimately the most important category, total returns. We all want to make money. Let's see how VIG stacks up against the good old dream team. All right, I'm out here on Portfolio Visualizer to do a back test to see how VIG compares to 50/50 of SCHD and VGT. So you can see here we're pulling the last 10 years, 14 through 23. We're putting $10,000 in without additional contributions. Reinvest dividends is on and display income is on. We'll see VIG is portfolio 1 and the mix is portfolio 2, as you can see with this right here. I hit analyze already and we're gonna come down. So that $10,000 with VIG would have became $27,650. Not bad. You can see the mix gets you up to $43,258. As these charts usually show with these passively managed ETFs, the trends are the same, just a little more extreme on the red bar, and it slowly gets separation. A little more ups, a little more downs. And on the year-by-year annualized returns, we can see that the mix wins 9 out of 10 years. It's starting at 14, you come over and you're good here, 15, 16, 17. Somehow it won in 18 as well in the down year. But the one thing VIG has over it is it has a little higher floor. You can see here in 2022 in a down market, VIG was only down about 10% when the 50-50 mix was down 16%. So it does give you that downside protection. And then on a roughly even or high market like these years, the mix excels. For the trailing returns, the annualized return here is where we want to live. For the last 3 years, you're up 8.5% with VIG compared to 11.8 with the mix. Over the last 5 years, a solid 13.84% with VIG compared to over 20% with the mix. That's pretty ridiculous. And over the last 10 years, which is the same as full because we have no year to date in here, we have 10.7% returns with VIG, pretty solid, to 15.77% with the mix. And for context, VU, the market, was up 11.99% in this period. And now looking at portfolio income with those dividend yields, VIG started a touch higher, but as you can see, the mix has been growing its dividend better over the years, and it's slowly separated itself, which actually becomes a bigger and bigger deal as time goes. Last year, you'd have $765 of dividends from the mix compared to $514 from VIG. These dividends are reinvested, but this is just to show how the income adds up if you did want to take it. Conclusion. I think that VIG is a great addition for any long-term focused portfolio. If you do want to add VIG to the mix of the modern 3-fund portfolio with the 3 components, I would consider it separately on the side instead of directly replacing a dividend ETF or a growth ETF with it. For example, if your current portfolio was 50% QQQM and 50% SCHD, I would turn the portfolio into 45 and 45 of those two and add 10% of VIG or something like that instead of taking only away from SCHD or only away from QQQ. When you take equally away from your growth in your dividend section, you're basically adding a hybrid that trickles back into both of them. Let me know your favorite ETF combos that complement one another in the comments down below. You know your boy here is rolling with VGT and SCHD, my tried and true combination, but I'm always open-minded and I love to see what you guys come up with. And check out one of these 2 videos if you want to continue learning and growing and heading down your path to financial freedom. Thank you so much for watching, and I will see you here every single Thursday and normally on a Sunday. Peace.